Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. Today, I'm joined with my good friend, Doug Heagren. Hey, Doug.
Good morning, Kirk. And camera's not working again, as it often doesn't. But happy Monday to you, and it's been one heck of an exciting weekend, so lots to chat about.
Good. Well, I'm glad it wasn't my 9 a.m. drinking or my lack of glasses that was causing you to look fuzzy. So thanks for clarifying that. And we also are joined by our good friend Kelly Coughlin. Hey, Kelly.
Hey, how are you doing, boys? Nice to be here. Thanks for having me.
Doing great. Well, we this is going to be a fun show. I don't know if those of you who are listening on LinkedIn Live are probably going to be privy to this, but we had a crazy weekend with a bunch of bank closures and maybe more to follow. And fortunately, we have Kelly with us, who has a background in risk management and all this sort of stuff. So, but before we get into all that fun stuff, let's get into Kelly's tax tip of the week.
Okay, tax tip of the week. It kind of pales in comparison to what might be going on in this banking market, but life has to go on. So my tax tip of the week is this. There seems to be a pretty big trend. We've touched on this a little bit in one or two sessions ago about this movement from high tax states to low tax states. I'm not making any judgments or recommendations on that, and it's certainly not a political thing for me. I look at it as a practical matter, and it's kind of like this. What we see out there is if you live in one of these states, New York, New Jersey, California, Minnesota, Massachusetts, Illinois, then it's getting attention, and there is this relocation going around. And I was talking to a couple real estate agents over the weekend in Florida, working on some tax work for them, and they had asked me about, well, do you help people that are trying to relocate and these things, because we see a lot of that. And so we're working on a program to help facilitate that and to help it go well and not poorly. When you decide you're going to relocate, you need to recognize that you are kind of poking the bear a bit, and they don't like it. Your Governor Walz doesn't like it up in Minnesota, Doug, and you guys have been dealing with that in MA for quite a while, and certainly in New York, California. So you are kind of poking the bear. Now, you can poke the bear. There's nothing wrong with poking the bear, but there's a smart way to poke the bear and win, and there's a dumb way to poke the bear and maybe lose, but also incur a lot of costs. So what we're doing is kind of helping people kind of pre-structure this and stage it in, and it involves these kind of things to look at. Do you have the ability to earn revenue, earn money from your business, whether it be W-2 income or self-employment, LLC type income, remotely, by phone, virtually? I'm not going to give all the answers to that, but that's one thing to look at. Another thing to look at is, do you own or rent your primary residence? None of these are deal killers, but these are things that need to be considered in the calculus. Another one is, do you have children who are in grades K through 12? That's a key part of it. Do you file a separate tax return for your business, or do you include it in an LLC, single member LLC? And you have to ask these kind of questions with your spouse too. So what we've done is helping people stage this thing in, that you don't try to pull this off in 1 year and just you wake up December 31 and say, I'm going to move to Florida or Texas, and I'm going to stop paying taxes in Massachusetts, Minnesota, California, New Jersey, New York. You kind of stage it in, and there's a right way and a wrong way to do that. And the tax tip today is, if you are thinking about doing that, then do it in a methodical, calculated way, not a reactive, I'm going to move down here, and you do it overnight and hope that you don't poke the bear. You will be poking the bear there. The more income you have, the harder that poke is. If you're only making 10, 12, 15, $20,000 a year, no big deal. If you're making six figures, they want your revenue. So that's my tax tip.
Yeah, Kelly, I can't speak for other states, but I know you have an intimate familiarity with Minnesota. I believe I heard that Minnesota is one of the states that has aggressively gone after this, and I think they've won multiple cases against individuals who have relocated, tried to call, make the snowbird permanent for tax purposes, and they've won almost every case they've gone after. So
Yeah.
What you're saying today, I know is really, really important, because there is a lot of people that just think, hey, you know what? Well, I'm just going to move, and I'm no longer part of that state. I'm not going to pay any taxes.
Yeah.
And Minnesota, definitely, if you live in Minnesota, I can't attest those other states. If you live in Minnesota, you might want to call Kelly, because they are aggressive and happy to come find you.
Yeah, well, I just got off the phone with last Friday with Franchise Tax Board in California. It was a client of mine 3 years ago. We started this, and they kept trying to go after him. I finally had this come to Jesus meeting and said, listen, guys, I don't file fraudulent tax returns. They were not residents of California. They didn't earn any money in California. You have no claim on this, right? And so I had to, again, submit their federal tax return to show that. Florida doesn't have a state tax return. We didn't have that to submit. Finally, got them off. It takes some boxing match type stuff, right, to jab and poke and win that. And I personally think it's better to have somebody that's tough like me that isn't afraid to mix it up, because they play hardball and they try to scare you and intimidate you. And frequently it works. It doesn't work with me. And so we help them get it done. So tax tip, if you want to do it, plan now. If your kids are, let's say K through 12, if they're in, 9th grade, 10th grade, something like that, and that's a long-term plan, start thinking about it now. Don't wait until kids are all out of the house and then think, hey, let's go to Florida. There's a better way to do it.
I moved from Texas back to Minnesota, and I remind my wife every year that as we continue to grow a business and become more successful, how much money that's costing for that move.
Yeah.
So
here's a little we'll move on to the next topic if you wish. Here's a tax trivia question. Which state started the very first state income tax in the U.S.?
Is it Massachusetts?
No.
I want to say Minnesota, because I feel it's a trick question, but no. Okay.
West Virginia.
Oh, God, wow. That doesn't surprise me, though.
What do you I mean, who would have thought that? I would have thought that'd be kind of like last of the party, right? But no.
Given how long Senator Byrd controlled Congress, I'm not shocked. West Virginia's got some weird influence on our national politics.
Yes, they do.
Yes, they do. Well, cool. Well, I appreciate that, Kelly, and I think it's great tax advice for everyone to think about. I know, given all the changes going on in the tax code and the grabby hands from all the state, local, and federal governments, people are going to want to shift around. They have been in the last few years. There's been a big migration out of California, New York, and other high tax states into low tax states, and I don't think that's going to stop. Because if you look at Maryland, 1 year Maryland instituted a millionaire's tax, and 85% of the millionaires left. So they repealed it because they figured, well, all right, we're getting less revenue than we had before. That was a dumb idea. So Massachusetts decided to try it recently. They thought, oh, well, it didn't work in Maryland. Why wouldn't it work here? I think a lot of states are going to try to experiment and have their grabby hands. So it's always a good idea to be flexible and mobile. And anyway, so let's get to the heart of the matter. So Kelly, your background, you certainly have a background in risk management, and I mean, to this moment, I don't know what's happening because things are so fluid in the banking market. But as of this weekend, Silicon Valley Bank, SVB, was taken over by the FDIC to help get people their money. And I believe Signature Bank out of New York, somebody was telling me, also went down, and First Republic Bank is, I guess, on the ropes. And there's which means, and just for the moment, what I mean on the ropes, what it means is they're a suspect bank. And the problem with that is that if you're suspect, everyone knows you're suspect, which means everyone pulls their money out, which is what a bank run is all about. Banks are, by their inception, insolvent. If you were to start a bank and you had, if you put $100 million in it, let's just say you put $20 million in it, that would allow them to lend out $100 million approximately. And so they lend that money out. Well, if I need my $20 million back, now that bank is insolvent. So the point of a bank run is that banks themselves are not solvent. What they're held together by is the FDIC insurance that I will get my money back if the bank goes under. That's why people hold their money there. Without that FDIC insurance, what happened in the Great Depression is everyone had there were bank runs and thousands of banks went under because people didn't trust them. Now we have that to keep people from doing a bank run. The problem is sometimes people have more than 250,000, which is what the FDIC insurance is, 250,000 per person per bank. So, if you've got $1 million, you got to have 4 banks if you want to protect your assets. Now, there could be things where different institutions, federal government institutions, step in and say, "Oh, hold on, we're going to guarantee everything." All that stuff could happen. However, at the moment, we have what we call a bank run. So, Kelly, I know you have a background in risk management. Kind of, what are your thoughts on what you've been seeing so far this weekend, and just in general your experience with this sort of thing?
Well, I get there's a couple facets to this, Kirk and Doug, that as you dig into this, there's different levels of this thing. You can get into the cost of funds, the arbitrage, or the spread there. Banks, as everybody knows, their cost of funds is what they pay on deposits, and then their earnings on funds is what they can generate through loans and other activities. And the spread there has to cover the operations of the bank, the payroll of the bank, the office and premises, and some kind of return on investment, dividend, or whatever it is to the owners of the bank. And anytime it's a delicate balance there, because they're pretty thin margins there. And on the earnings side, if there's any overreaching on the earnings side of that, not the cost of funds, there's never overreaching on the cost of funds. They never generously pay you more on your deposit, right? They do absolute rock bottom minimum to get the funds in. But there tends to be potentially overreaching on the earnings side, and that comes out in the form of credit quality. How good of loans are these? I haven't looked at the balance sheet and the loan portfolio and earnings portfolio on SVB, but they did deals that were kind of the heartbed of this ground zero of Silicon Valley. And most of these companies didn't, in their early stage, wouldn't have met the standard kind of credit criteria of earnings coverage, that sort of thing. So I don't know how they got the deals done, but I'm sure they got, somehow they were able to get the deals underwritten. But then you get into what was driving their loan decisions, and this is kind of a politically sensitive area that I'm just going to be straight with, and you'll probably get some ripping and criticism on your channel. That if you look at their criteria, it was more about equity, diversity, and inclusion. That was the thing. And I mean, just go to the website. There's not, just go to the website. You can see what this culture of this bank was, and it was perfect for Silicon Valley. Perfect, beautiful. That's what they want, and they got it. And when you let those kind of decisions drive your lending decisions and your investment decisions, this is what can happen, and it did.
That's so I did want to ask you, Kelly, because I'm sharing a chart here right now. For those of you who are seeing this on YouTube or live on LinkedIn, we're kind of showing a chart of the impact of unrealized security loss on capital ratios. I know for the listeners, your eyes are glazing over and you're like, whatever. The point I wanted to use with this chart is to show it shows a bunch of different banks. It shows Silicon Valley Bank as one of them. Obviously, it's very low, but I think in comparison, it shows banks like J.P. Morgan, Citigroup, Bank of America, Wells Fargo, M&T Bank, all these different banks, and shows there are some that are that have let's just say that'll have a bigger impact than others. And I don't know if you can kind of explain this, Kelly, in layman's terms. If it's too technical, then we might skip over it. But I don't know if you can do that.
Oh, I don't know if that's that helpful. Frankly, I think it's kind of getting into the weeds. I really think the bigger picture on this thing is look at what the culture of the organization was, and look at where they were trying to get their return, and if there's any slip up, what would happen there? And you have banks that, banks in Texas back in the 70s and 80s, they lent money in the oil patch, and they were highly profitable and successful for a while, and then some of them went under for that. And so it's really important to see what the culture of the organization is, and do they diversify their portfolio of the risk that they're taking in concentration in certain industries. And I don't think these guys did. Again, I want to be careful about Monday morning quarterback type stuff, but I don't think it was rocket science to predict that if there's going to be a hiccup in the tech sector in Silicon Valley, that these guys would suffer. But I think the more prevalent thing is, if you're making your business decisions, your lending decisions off of, I think Vivek Ramsey, I think that's his name, calls it woke capital, right? You're going to end up with potentially a problem. I think that's the lesson, and not this. I mean, this is a cool chart and all that, but I think the thing to look at is that bigger picture stuff.
Yeah, I think your point's really valid, and this, a lot of this is fog of war stuff, and personally, I don't really like commenting on stuff when we're still in the fog of war, because the news tends to just throw stuff out there, and it's not really necessarily accurate, but they feel like they need to. So, but some things that I did see, which I thought were remotely comical this weekend, was I think it was a chief risk management officer or CFO of Silicon Valley Bank also happened to be the CFO of Bear Stearns, something like that. I thought that was
their new one, because they just got a new one that came in like a month ago.
I don't know. I'll have to go look this up. I'll pull it up and see if I can share it. But I thought it was hilarious that somebody threw this out there, that it was actually the same one that was at Bear Stearns. I was like, oh, you can't make this stuff up. Like there's anyway. I guess only people like myself maybe find that funny. But anyway, so I do want to kind of talk a little bit about you were talking about culture. And, Doug, how much time do you have with us, Kelly? Because I know you got a hard deadline here.
I've probably got another 5 minutes. I'll hang out for a bit.
Okay. I do want to talk about like culture and that sort of thing, because I think that you know, a lot of people are probably sitting, well, is my bank safe, right? Is my cash going to be safe in my bank? Well, let's start by saying the first thing you can do is make sure you don't have more than $250,000 in a single bank per person. If you have less than that, then you're FDIC insured, and your cash should be safe. Now, I do want to point out that the cash itself may be guaranteed by the FDIC, right? It is insured. They don't guarantee when you'll get it. So I want to be clear. If you have all of your money in a bank and they go into receivership, right? The FDIC will guarantee your money up to 250,000, but they don't guarantee when. Now, if 100 banks start going down, or we have a 2008 situation, you could get it 6 months later. So I'm pointing this out as a point of risk management. I'm not saying that all banks are bad. I'm not saying that the whole system's going to implode. What I'm saying is, if you have all of your money in one bank and it goes down, then all of your money is going to be tied up. So this would be a good time to find another solid institution that you can put extra cash in. If you have, let's say, 200,000, put 100,000 in another bank, or put it into a brokerage account, which also has, some of them have FDIC insured, some of them have SIPC insurance. But either way, find another institution. Spread your risk around. Don't have all of your eggs in one basket, because you'll find you might wake up Monday morning and you have no cash. So I'm not trying to cause a bank run here, Kelly. I'm not trying to do that. I'm just trying to say that, for all of us, it's a good time to be prudent. It's a good time to be prepared. Being through this a few times. I mean, you've been through this a few times, Kelly, right? You've seen this. You've
Yeah,
seen
and that's why I think
and
let's try not to get into the weeds too much, but look at the bigger question I would be asking is, yeah, I think it's if you got $1 million at your community bank there, yeah, maybe you spread it out a little bit. But the more important question I would ask is, how are you earning? I'm asking my bank, right? How are you guys earning your money? What's your source of revenue? And well, we do loans. What kind of loans do you do? What industry sector? Can you give me any breakdown of that? They file these. I can't even remember right now what the bank report is that shows all this data that you can get. Brokers call it focus reports. I just spaced out the name, but it gets all of the data that you can get. They have to file that, and there's tons of really good data out there. But I would be asking the question, what types of deals are you guys doing? Where's your risk management? Where's the concentration? Are you focusing on industries? SVB they were front and center. We're DEI. We're equity, diversity, and inclusion. We've got it. We've got that nailed. And so if you're comfortable with that, and if you think there's a correlation between success and that, go with it, right? I don't know that there's any. It might be a feel-good thing, but I don't know that there's any correlation between success in the oil industry, success in financial services, success in DEI. I don't know. I don't know if there's any correlation there. Again, I'm not trying to be political on this thing, and I'm certainly not opposing, diversity in the workplace and in the company, and getting more females involved. I've got 4 daughters, so hell, I'm totally supportive of promoting women. But my God, not at the expense of success. Likelihood of success is what needs to rule the day, not skin color or gender or who's going to do the best job at turning a profit in this enterprise and managing the risk there.
Yeah, no, I couldn't agree more, Kelly. Well, Kelly, I know you're kind of coming up on time. Thanks for joining us this week, and thanks for sharing your tax tip. I know we'll definitely have you on next week for another tax tip. Thanks again.
Peace out. Bye.
This is a public service announcement. Hi, my name is Kirk Chisholm.
and I'm with the government, and I'm here to help. Doesn't that sound reassuring? Well, let's talk about how they're helping. The government needs your help to make our money worthless again. PPP loans, student loan forgiveness, helicopter money. Let's keep the party going until our money is totally worthless. Don't think it can happen? Sure it can. Just ask Zimbabwe, Venezuela, Greece, Germany, Hungary, Greece, Yugoslavia. Did I say Greece? As a loyal listener to their show, I want to give you free money. I'm giving away free money in one of these hyperinflationary currencies. Go to www.moneytreepodcast.com/free money and follow the instructions to get your free gift. I have a large audience and only a limited supply of these currencies. I'm not the Federal Reserve, so I will run out at some point. Make sure you get yours before I run out. Go to moneytreepodcast.com/free money. Follow the instructions and get your free money today.
All right, Doug. Well, I think we got a lot to chew on here. I will say that the point for what people are what Kelly was talking about with this is that there were a number of people there that were in charge of risk management that basically their entire profile was talking about kind of DEI stuff. Like like 99% of it was about diversity, equity, inclusion, and there was nothing about risk management in their profile. That's what Kelly was talking about. So this is going around on Twitter and a lot of different social media showing that the people that are in charge of risk management at this bank, and people were focusing on, quite frankly, the wrong thing. Now, I think this is a Silicon Valley bank, which of course that aspect is deeply ingrained into the people that are there from a political standpoint and ideal, from an ideology. However, so I think there's an element to this where that's your audience and you have to play to your audience, right? And that is capitalism as well. But I do think Kelly makes a great point, which is this is capitalism, right? We talk a lot, Doug, about this show, about the green energy and how people want green energy and they want to save the planet. And in many cases, what that does is that's in spite of the fact that you're going to make everything more expensive for energy, and poor people are gonna be in a harder position because of it, all because you want to green the planet, or focusing on stocks that meet certain criteria for governance, the environment, and the social aspect. And this ESG issue is fine if you want to do that, but do you want to do that in spite of making money, right? Like, it's not going to change the environment at all if you invest in one company that's green versus one that isn't. It's not going to give them any more or less money. It's just whether you want to make more or less money. So I think the capitalism aspect always has to come to the top, and I think in environments like this, it typically does. But Doug, let's kind of get into it. I mean, this was a rough weekend for a lot of people if they're waking up Monday morning and their bank accounts are frozen. So, kind of, what are your thoughts on this?
I've been waiting a bit. Hey, throw that chart up again for me for a second. The one that showed the bank.
There we go.
So here, layman's terms, what this means. Quick takeaway. And if you really focus on SIVB, you'll notice that the brown bar. I mean, hold on. Can you zoom in a little bit? I might be able to see it. Maybe you've got like a spectron microscope or something, because it's not there. That's the point. Here's here's what this is saying. This is the common equity tier 1 capital ratio. This is the ratio of assets that they have versus what they're lending. Okay. Brown line, the brown bar, is what they actually have available as capital after you recognize how much they've lost money and haven't recognized it yet on the security investments. Now, the key here is if you take a look at JPM and Citibank and MTB, they're looking pretty good. If you take into their adjusted unrealized losses on securities, they don't really have a lot. And so what's happening is that the actual value of their tier 1 capital ratio is still pretty high. But you take a look at SIVB, what happened is they basically had so many losses on their books that were unrealized that they had no capital. Okay. They had nothing left. And what happened is it started to go around in a rumor that they were started, that they were desperately in trouble. People started talking about pulling money out. And what they did is then when they started to pull the money out, as banks have not had to do, since 2020, have any reserves, they didn't have the money in hand. I mean, that's how the banking system is built. The banking system is built to take your money, lend that money out, make money. And one of the things that came out about SIVB is that they were trying to entice people to keep the cash in the banks. Same things that all banks have tried to do. By what has come out is they were encouraging people to keep their money there at a higher interest account. Okay. Well, how do you think they pay that account at interest, Kirk? They've got to make money to pay money. Okay. That's how it works. Right. So what they did, and some of this is, you could definitely put a lot of this back at the fault of the bank. And by the way, you were asking about, you were mentioning who it was that was involved in the Lehman Brothers. The gentleman, he's actually the chief administrative officer. His name is Joseph Gentile. He is the chief administrative officer of SVB. Prior to joining the firm in 2007, he was CFO for Lehman Brothers Global Investment Bank, where he directed accounting and financial needs within the fixed income section. Now, that is not Lehman Brothers Holdings. He was way down. Somebody else put a flow chart. It was one of their many, many sub-entities. But he's getting this, his direction, his learning has come from Lehman Brothers. And by the way, once again, we had a mortgage-backed security leverage. Guess what happened in 2006? So we got to learn something about mortgage-backed securities. There is risk there. But this is where some of the blame's on the bank, and a lot of the blame is on the government. Okay. First of all, in 2020, in order to lend out PPP, the banks went to the government, who was telling them to lend this money out, and said, look, your reserve requirements make this impossible. We can't lend it. We're restricted. And so the government lowered reserve requirements to zero. It basically said you don't have to keep anything on hand, which violates all of the principles that were in place going back, not just in 2020 and not just in 2007, all the way back to the Great Depression. Because what happened in the Great Depression is they created something called demand deposit. Because again, if anybody's ever seen It's a Wonderful Life, great example of the run on the banks. They need their money. Jimmy Stewart had to use his honeymoon money to keep the bank, the savings loan open. Okay. Well, basically what happened is they took and they said, look, you don't have to have any reserves. After the Great Depression, they created demand deposits. It's your checking account. Basically, it says any amount of money that you have in demand deposit, instantly demand, must be kept on hand. 2020 got rid of that, which means they weren't even keeping enough money for checking accounts. So when people started to ask them for money, they didn't have it. Okay. And that makes people panic. And then, of course, they have to come up with that money. The other part that the government is at fault with this, and the bank, is the interest rate issue. And this is, I think, going back to what you were talking about, Kirk, is what can we learn from this as a society? How long have you and I been saying fixed income is not a safe investment? Okay. People firmly believe it's a safe investment, and there's arguments in history to say that it is a safer investment than equities in terms of volatility. But when fixed income gets unsafe, nothing is less safe. Equities, unless as a mass, companies generally come back on indexes, but fixed income can stay down for years. It's all tied to interest rates. The government went in, and this goes back to the Federal Reserve, kind of promising a little bit of mouth speak, hey, what we're going to do, inflation is transitory, blah, blah, blah. So what did this bank do? They went out and bought safe investments. They bought mortgage-backed securities and long-term treasuries, which we're finding out right now as the Federal Reserve has jacked up interest rates. Not really a good thing. You've been saying it forever, Kirk. Okay? What happens when interest rates go up? You've shown the charts. Massive decline in the valuation of fixed income. So all of a sudden, these banks are all sitting on long-term investments that are worth much less on the market that they paid for them, thinking, again, and these are supposed to be the smart people, right, Kirk? These are people that do money for a living. And they went out and bought a bunch of long-term investments in a potentially short-term interest rate risk environment. And what happened? Now they're sitting on unrealized loss on securities. And you can see there at SIVP, that pretty much wiped out their entire capital ratio. They had no choice but to go out and then realize those losses by selling those fixed income securities to raise the cash to pay off the individuals that were again making the run on the bank. Government comes in, says, look, if you don't have that money in a short 24-hour period, we're coming in, taking you over. And that's what they did. Now, there's been some updates that happened yesterday. I don't know, Kirk, did you hear about the announcement from the Fed for the bank term funding program?
No, I've not heard that yet. I've been trying to filter through a lot of this.
Yep, this happened yesterday. Okay, so they announced last night that they are going to make everybody who was who had money in the bank whole. Okay, they came through and the government said they're going to back it. They announced was the bank term funding program. I don't know the details on this. There's some talk about how maybe the hedge funds and venture capitals are behind this. I'm not 100% sure. Some of that's hearsay, but this is straight from the federalreserve.gov website right now. But basically, they created this to support American businesses and households by making additional funding available to eligible depository institutions to help assure banks have the ability to meet the needs of depositors. So what they're going to do is they're going to supersede the FDIC. The FDIC backs up to $250,000. But what the BTFP will now do is offer loans of up to 1 year in length to banks, savings institutions, credit unions, other eligible depository institutions, pledging U.S. Treasuries, agency debt, and mortgage-backed securities and other qualifying assets as collateral. They're valued at par, and that will be an additional source of liquidity against high-quality securities. That right there, Kirk being subjective, eliminating an institution's need to quickly sell those securities in times of stress. What they effectively did is they said to all of these institutions, go out, take bigger risks, be fully leveraged. FDIC be damned, we got you.
Yep.
So I said something this morning that was going around that basically a gentleman was talking. He was kind of talking about the impact of what's going on, what this could lead to, and I think that there is some incredible challenges that this could lead to. And I think he made a really good point. The gentleman's name is Rajat Sani. He's a CFA. I was on his Twitter account. But basically, he talked about before March 26, 2020, that the system was based on fractional reserve banking. And in essence, they did not have to have all your money on hand. And then it went to zero. But what this new thing is going to do, and SVB was one of the banks that could do whatever it wanted with the client deposits to make a profit, invest in any asset, regardless of time horizon. Again, even if there's mismatches about that money being needed. Of course, since this is where the government comes in. And since U.S. Treasury notes are considered free from risk of default. Well, yeah, but unfortunately, while it had the assets to back the client deposit, it didn't have the cash. That created the 36-hour run-on. So here's what the blending program, basically, it's going to meet the needs of the depositors, but also the risk of that is now banks can take risk without being worried about a bank run anymore. Bank run equals too many people withdrawing. If they don't have enough money, they can just take a loan from the BTFP. Now, it sounds great, but here's the issue he sees, and I can see this too, a greater wealth gap, all right? Banks can now buy even more assets, push their prices up. What do we know about banks? They pay executives and employees huge bonuses based off of profit, not necessarily based off of long-term smart decision-making. Now they can borrow from depositors to buy those assets. They can use those assets to borrow even more. Now knowing the BTFP can lend to them if they ever want their money back. It's great short-term. Everybody feels good short-term, okay? But the problem with this, Kirk, is a long-term problem. The average person, again, there's an argument to be said that this could lead to greater inflation, a greater unaffordability of assets, a greater issue with the inability to store wealth, because currencies, guess what? They can be, unfortunately lose value. So it's going to be very, very interesting to see how this plays out with what the decisions that were made last night. Good news, short term, all of those that are at risk are going to feel really good. But adding this new lending program fundamentally changes the entire safety structure of the banking system. And since I know you said you hadn't had a chance to really see read this is about, Kirk, what are your initial thoughts based on what I just said?
Well, actually, I think when you described it, I hadn't read that, but I was aware in large part of the government basically coming in and securing all the deposits for the Silicon Valley Bank. But so here's the thing. So, it's funny because when I scheduled this out last week and we were going to talk about the banking system, I was kind of mad at the time. And it had nothing to do with this. This is just another reason for me to get mad at banks. So here are my thoughts. Okay. I was mad last week because here's the situation. Banks on a national average are paying about 35 basis points on savings. Okay. So that's 0.35%. If you have $100,000 in cash, that pays you what, $350 a year? That's nothing, right? So if you have money in a bank, you're basically giving them money. You're taking the risk of the bank basically having a run on the bank and being into receivership with the FDIC, and they're giving you 35 basis points. Now let's take another situation. You could take that same 100,000. Now, by the way, I just want to preface this. I'm not saying everybody take all your money out of banks. I don't want to cause a bank run. What I'm saying is that you have to understand how screwed up the system is right now. Okay, banks are paying you 35 basis points to your money. You could take that same money and you can put it in U.S. Treasuries at 4.5%. Now, I also want to point out it was 5.3 late last week before the bank run. But because everyone's worried about the bank run, all of a sudden the U.S. Treasury rates have gone down because people now think that all of a sudden the Federal Reserve is going to come in and bail everybody out again and interest rates are going to go down. That's why rates have dropped. And this happened literally like within a day. It's an enormous drop in that, which if you own treasuries is great. You just made some good money over the last 24 hours. However, the Federal Reserve has not come out and said, hey, we're going to drop rates. So I do think that it's going to pop back up to the level it was before because, frankly, it deserves to be there. Unless we have a bank run, the whole system implodes, in which case rates will go down. But that's a whole other problem. Let's say that doesn't happen, which I think is less likely because I think, the government's going to come in and just say, oh, so as Doug said, it gets into this problem of moral hazard, which I want to address in a minute. So the reason I'm mad is banks are screwing you. And I hate to use, this kind of language, but banks are screwing you. They're giving you 35 basis points. Historically, they've given you a very similar rate to, treasuries, CDs. They all had kind of a similar rate. And banks are trying to compete for your money. But they're not competing for your money because they don't care. No one is giving you any sort of return. Banks are making an enormous amount of profit off of your cash. You give them $100,000, they're making 5%. And you're making 35 basis points. Why would you do that? Why would you keep money in a bank if they're screwing you like that? You're much better off opening up an account, getting a brokerage account, putting it into 3-month treasuries, which I mean, right now they're probably, 4% or maybe a little bit lower, but you could put it into very, very short-term treasuries. I think the 3-month treasuries right now are paying approximately 4.5%. They're paying 4.5 instead of 35 basis points. I'm not saying take your checking account and take it all out. I'm saying if you have a savings account that is emergency fund money or stuff that you just, you keep it around just because you need to, you feel safe psychologically, whatever, at least get a good return on your money. Don't give them free money that they can make 5% on and you get nothing. Make $5,000 a year on it or $4,000, whatever it is at the time. But don't short yourself the opportunity to make money. There are a lot of really low risk fixed income out there. A treasury bill, or let's call it a 3-month treasury. Let's say you don't need the money for 3 months. You're getting 4.5%. That's awesome. It's a U.S. Treasury. That's great, right? It's safe. You can also look at other things. But I do want to point out, and before I get into the moral hazard issue, because I want to go back to this, you want to make sure it's FDIC insured. But you also have to take into account the fact that if you own a money market fund, that is not FDIC insured. Money market funds are a way that banks say, oh, you buy this money market fund and you'll get a higher return. Yeah, because they're making commission off it. Don't do that. A money market fund, I'm not saying money market funds are bad. I'm just saying if you think it's FDIC insured, you're going to be, you could be in trouble, right? And remember back in 2008 when one of them broke the buck and people lost money. You don't want to look at a money market fund if you're really worried about safety, okay? FDIC FDIC insured banks, SIPC insured brokerage houses, those have safety, or cash under your mattress or in a safe deposit box, whatever. There's some safety there, right? There's always risks in everything, but at least those are kind of the lowest on the totem pole. Money markets are not safe. So make sure, because a lot of money markets, they're trying to get a better return to compete with each other. And it's a silly game because they don't make much on it anyway, but that's the game. So just make sure that if you're in one, it only owns U.S. Treasuries, short-term U.S. Treasuries. That's probably the safest you can get with money markets. Don't make sure it doesn't own this junk paper, these corporate bonds, short-term commercial paper. Sometimes you can get in trouble because it might be with some banks. I'm going to make another point. Be careful of preferred stocks. Banks typically have attractive rates on preferred stocks. But these preferred stocks, and I've been saying this in the show, and those of you who have been listening every single week, you know I've said this, preferred stocks are, in normal times, a great place to get extra yield. The problem is we're not in normal times. They started to implode last year, and the problem with banks is each one of these preferred stocks, they typically have, it's basically a contract, right? The bond has certain rules. Well, the rule is they're going to pay you 5%. And in exchange for that 5%, you're going to take certain risks, right? The risk is, well, the institution could default. They could stop paying interest. Well, in most preferred stocks, if they stop paying interest, that accrues, right? And then, let's say they come in hard times and that they start accruing the interest. Eventually, they have to pay it back, right? Or else they default. But preferred stocks are set up so that they can defer that if they get into trouble. And of course, if that happens, there's a whole bunch of other things that will happen. But it accrues, and they still owe you that money. Now, banks, about 5 years ago, this started to become a trend. Banks started to put in their contract that the interest is not accrued. They call it non-cumulative. Non-cumulative interest. If you own a preferred with non-cumulative interest, you could potentially just be lighting your cash on fire, okay? Because that means that they can stop paying interest and they don't owe it to you. At some point down the future, 10 years from now, they could decide to start repaying. They don't owe you that 10 years. They started, almost all financial institutions started doing this years ago. And I thought it was the worst thing I've ever seen, but they do it and people don't pay attention because they're like, oh, I can get an extra 10 basis points. So I'm going to take this bank as opposed to this other company. So be really careful about what you own. This is the kind of environment back in 2008. If you don't know what you own, if you don't know the risk, you could really get yourself into trouble. If you have questions, email us. We'll talk about it in the show. Send us your questions. But risk management is what we do. We've been through this cycle before. It can be a scary cycle. I'm not saying the system's going to implode. I'm not saying that at all. I'm saying that you have to be prepared, right? I'm not saying you have to freak out. I'm saying you have to be prepared. If you're not prepared, now's a good time to be prepared. Now, I do want to get into the moral hazard issue because I'm really mad at the whole banking system. And you said this, Doug. And if you go back in history, okay, let's go back a few decades. It used to be that financial institutions were partnerships, not banks, but brokerage houses and M&A investment banks. A lot of them were partnerships. Now, what a partnership structure means is that if you're a partner in these firms, you're putting your personal capital at stake. So if the firm goes under, all of your personal assets go into the bucket for collection for anybody who needs to get paid back. So you are personally on the line if the firm goes under. How many of these partnerships do you think went under, Doug?
Are we talking post Great Depression? I'm going to guess 0.
Yeah, close to 0. I don't know the exact number, but it's close. It might be like 5. It's close to 0 because these partners did not want to lose their personal wealth. They were making a mint. They didn't need to take these ridiculous risks, right? And so they made really sure their firms were safe. Now, what happened when you get into the late 90s? Well, what happened was these firms realized that they don't need to be partnerships. Goldman Sachs went public as basically as a corporation, which means that everyone's personal capital is shielded. So you can take as much risk as you want, and you are going to be A-okay as an individual. This is what we saw at Lehman. We saw at Bear Stearns. Now, some of these people, these partners, had 99% of their wealth in the stock, which is a whole nother problem. If they did that, that's their own problem. But they could have easily sold all their stock and put all their cash into real estate, whatever else they were. They would have been totally safe. And that's part of the problem is the corporation structure allows financial institutions, which are effectively at birth insolvent, they allow all these people to take risks and they're not personally on the hook. So, Doug, if I said, I'm going to give you $1 billion, you can do whatever you want with it. If you win, you're going to make lots of money. And if you lose, you're not going to lose any of your own personal money. Would you take that bet?
Absolutely.
Yes.
Say that.
You don't have to think about it.
Yes.
The answer is yes.
Sorry. I was reading something else because I have something to talk about with that. But yes.
Okay.
Yeah.
I'll get to that in a minute. But the matter is you're giving these people a license to print money. They can take as much risk as they want. And this is what a lot of hedge funds did is you get paid 2 and 20. You get paid 2% for all the cash. Any money you make 20%. If you lose money, so be it. Right? Now, not all hedge funds do this, but there are a large number who take an enormous amount of risks because if they make a large amount of money, great. If they lose it, oh, well, whatever. I've still got my billions of dollars in personal wealth. So you should understand this about financial institutions. Now, banks are different. Banks are typically a lot more conservative in their practices. And as Doug says, like in the case of Silicon Valley Bank, what's really interesting is that, in nature, their customers were technology companies and people who worked at technology companies typically, and sometimes bank runs are not because the bank is in bad shape, right? They actually had a solid balance sheet. They were invested in, I think it was 61%. I could be off in these numbers, somewhere around 61% or more of their securities that they owned were like U.S. Treasuries, which are fine. The problem is if you own all this stuff and people need their money back. So let me give an example. So let's say you bought a 30-year Treasury note 2 years ago, right? It would have been paying you somewhere around like, let's say 3%, okay? And these numbers are a little off, but I'm just trying to use this as illustrative purposes. Let's say it's paying, let me forget. Let's use 10% because 10-year Treasuries, okay? 10-year Treasuries a few years ago, let's say they were 1%, okay? They're paying you out 1%. Now they're paying you out, sorry, I have to go back to the page. Now they're paying you out approximately 3.5% as of today. I think they were actually higher, but let's call it 3.5. Okay, so now they're paying 3.5. What that means is you're getting paid 1%. Now somebody else wants 3.5, which means that your treasuries are actually down in value. Okay. Now what that means to you is that you're still getting your 1% a year. It doesn't really matter. So this bank could have owned the 10-year treasuries and they still be getting their 1% a year. That's okay, right? However, as long as nobody needs their money back, there's no problem because 10 years passes, you get 1% a year and you get your capital back. There's no problem. The problem is because it is now 3.5%, instead of investing $1,000, you wouldn't get your $1,000 back. You might get $800 back, which means you lost 20% of your money, right? This only matters if you're forced to sell. Now, if depositors rush the bank and say, we want all of our money back, now the bank is forced to sell these securities that are at a loss, but they don't have extra money to cover that 20% loss that they have, which means that they're insolvent. So effectively, the bank run, people trying to, these tech companies or whoever, pulling their cash out caused the bank run. So a bank run is actually really interesting. It's actually it's psychological, right? If you think there's a bank run, what are you going to do? You're going to pull all your money out, which effectively causes a bank run.
It's emotionally driven. You don't want to be the last person trying to get your money out, right? So
right. It's the concept. Karl Popper came up with this. George Soros talks about this a lot. It's this concept of reflexivity, right? Reflexivity is an action causing more of that action. Right. So if you think there's inflation, your behavior is going to be reflective of inflation, which effectively causes more inflation. If you think there's deflation, your actions are going to be pulling money out and putting it in cash, which causes more deflation. A bank run is effectively people thinking there's a bank run, which causes a bank run. It is reflexivity. If you don't understand reflexivity, learn it. It is going to tell you everything you need to know about the financial system. And this is what's going on now, is this concept of reflexivity. Everyone out there is afraid of their cash. You don't need to be afraid of your cash. You need to be afraid if you have more than $250,000 in your bank in one person's name, because that could be at risk. Your bank might be totally fine. There could be no problems, but you should diversify your risk now and make sure you have less than 250,000. And by the way, if you have $250,000 in your bank, and somehow you're getting your 35 basis points of interest, then you won't get that extra, whatever, $350 or whatever. I know the numbers are wrong, but you won't get that extra $350 of interest. I think it's about $1,000. You won't be getting that interest at the end of the year if the bank is taken over. You'll get your $250,000 back. So I say this, and there's a whole bunch more, and we'll probably talk more about this on Friday because it's such a big topic, but you should all be angry at what the banks are doing. You should not be having all of your cash there. You should find a better place to put your cash that's getting you good interest. You can get it in a lot of places. CDs are paying a better rate. Treasuries are paying a better rate. The U.S. Treasury Direct is paying a great rate at 6.8% or something crazy like that. Go find secure, and these are secure places. These are low risk investments, right? This is not a junk bond. This is not high yield debt, which, by the way, high yield debt is not paying all that great anyways. Well, actually it is right now, but typically, for the last few years, it wasn't. And municipal bonds are actually paying a good rate. You can get AAA rated municipal bonds at 4.2. That's triple tax free. That's 4.2%. You're not paying taxes on the U.S. federal government, on the state government, or your local municipalities. Triple tax free. Municipal bonds there's certainly some risk of them defaulting, but at the basis, those are great investments to look at if you're looking at, if you're wealthy and you have a really high tax bracket. I'm not saying today look at municipal bonds because I'm not sure they're better now than any other time, but you should understand how they work. So, I know you have a lot more to talk about, Doug, but I want to go on that rant because I think you need to understand what's going on with banks and how it affects you.
First of all, I want to say, and I'm not telling you to run out and get this, and I know it's incredibly controversial, but a lot of what you saw this weekend, it talks about FDIC and protection of your cash and how safe really is your cash. By the way, there is an argument to be said, and there are certain people that firmly believe that this is one of the reasons that if you have it or don't have it, cash value life insurance, as much as it is controversial and polarizing, there are a lot of people that firmly believe it can make one of the best cash reserves you have, because there you have something that's protected. Insurance protects itself. I'm not going to get into the details on that, but obviously more than the banks have protected your cash in many cases, and the yield is higher. The other thing, as an accessibility is guaranteed. The other thing, though, I will tell you is I just gave a chart, Kirk, about the biggest bank collapses that we've seen. Of course, now Silicon Valley Bank comes in at $209 billion, right behind Washington Mutual at $307 billion. And then there's a handful, there's quite a few bank collapses that you can see surrounding them that are going to be, in the multi-billion. IndyMac being third at $32 billion. United Commercial, $11.2 billion. Add that to United, $12 billion. I believe that might be the United Credit Union. But then you've also got, just a number of things. And here's the problem. And here's really where it comes down to the big issue that has happened. And I'm trying to find it here. The bill, shoot. I had it up, and then I started moving stuff around. Sorry, Kirk. But basically in 1933, they passed a bill that prevented the separation between here it is. It's Glass-Steagall Act. The Glass-Steagall Act of 1933 was passed to force commercial banks to refrain from investment banking activities in order to protect depositors from potential losses caused by bank speculation stocks. Largely repealed, though, in 1999. And although some parts of it remain, including Federal Deposit Insurance Corp., which is where that was created, unfortunately, most of it is gone. Now, listen, Kirk, you and I, for the most part, probably agree that we are predominantly anti-regulation in most areas, because a lot of regulation starts to impose on individual rights. But there are some areas in which regulation does make sense, especially with regards to the common good. Like, it's good. I know as big of a pain in the butt as it is, it's good that we've got the FAA. Most people, when they walk on a plane, really would like to not have the plane crash. And if you look at what they've done in the history of regulation, and some deregulation. But the regulation of the airline industry has made it one of the safest ways to travel, more safe than walking. Okay, especially with cell phones these days, people just walk right in front of the street, right in front of you. So they did it the other day to me. Absolutely, mobile phones make another sign that mobile phones are making us all a little bit more stupid. But guess what? 1999 Glass-Steagall Act was repealed. What did that create? It created your everyday bank right down the street that you've kept your safe money in, and allowed them to now go take that money, and instead of doing what you talked about, that partnership that they used to have, having to be safe with your investments, it allowed them to go out there and invest in whatever they want. Okay. And a lot of that took the risk, and a lot of that led to the crashes of 2008, and it's led to the bank collapses that we've seen a tremendous increase of over the last 20 years. Guess what? Guess when all of these problems happened? What? 8 years after they repeal it, we have the Great Recession. Okay? And what was that tied to? A lot of really poor investment decisions, leverage, and credit. So again, here is an argument where, again, when you're putting your money safely in an industry, the common good might be an argument for some regulation, because unfortunately, as we've seen, now these banks, based on lack of partnership, based on profitability, based on short-term thinking and huge bonuses to executives, they don't care what happens to your money. They take this money, and it goes back to show you the banking system is not there to help the little guy, okay, at all, right? And this is a fact, and this goes back to what Kirk was talking about. But ultimately, this is where we are going to continue to see, not just this, but more volatility in the banking sector until other types of regulations and restrictions get put in place. And going back to what just happened over the weekend with the ability to now have more money being lent based on the new bank term funding program, which is going to supersede the FIDC. Once again, it didn't pull back and make anybody feel responsible for some of the decisions that were made. It ultimately said, you know what? We don't want anybody to get hurt. We're going to kick this can down the road. We're going to give a way that this banks can't collapse if they're over leveraged. And unfortunately, there is no reason whatsoever for those banks to rein in the risk, unfortunately. And I think we're going to see more of this. I think this is a paradigm shift started in 1999 in the banking industry, where every couple of years, when things don't go absolutely perfect in the markets and the economy, we're going to see banks be some of the first to fail. Yeah. So be prepared and diversify.
All right. Well, Doug, I'm going to go into one more thing. I'm going to wrap it up. I think we're going over time here. So yeah, I just wanted to point out a few things, and I wanted to go into a little bit of real estate. We'll have to save that for next week, because real estate's also having some issues. But I wanted to share this because I thought this was funny. I think Forbes is having a real rough time lately. First they had the SBF on the front of on Forbes in the top Forbes 100. And now you got SVB is ranked the number 20th best bank in America. So I think Forbes is having a rough time lately. But I guess when you're publishing,
they might want to start doing some research instead of just getting caught up in the glory.
Yeah, well, I think one of the challenges is with a lot of this stuff. I mean, I don't think Silicon Valley Bank was a bad bank. I think they weren't their risk was not managed properly, and it's really hard to know that because frankly, we talk about this a lot in the show. People don't do their homework. They don't do the research, and it's like the rating agencies. The rating agencies aren't doing a bad job. But, if you really were looking for deep research, you're not going to get that from them. They're getting paid to give a rating, for companies. And we saw that in the global financial crisis, where they're basically getting paid to give AAA ratings on piles of crap. And, their comment was, well, if I don't do it, they'll go down the street and they'll give it. And so we're just basically losing revenue, which, the fact that our system shows this is a problem. And here's another one. Here's an aggregate of analyst ratings for SVB. There was not one sell rating. There was only one underweighting, 5 hold, 5 overweight, and 12 buys. So consensus price target was 337. Well, you're not getting that now. So, if you kind of look at this is pervasive in all Wall Street, and I bring those things up not to poke fun, although I do enjoy that. It's more to prove a point that you can't put 100% faith into what Wall Street tells you. Their job is to sell you stuff, and our job is to help inform you. And so, if you take Wall Street's word at their word, it doesn't mean they're lying to you. And I'll be really frank. There are a lot of really, really honest people in Wall Street, and they're not lying to you. They're probably misinformed. They're not doing risk management. Their job is to sell, and they might want to do the best thing for you, right? And I'm sure there's a lot of people out there that are listening. They probably have financial advisors. The financial advisors are probably not out there trying to screw you. They're probably really good people who really want to help. The problem is they're getting bad advice. The system is broken. You have situations like this. You have SBF, you have FTX, you've got, Bernie Madoff. You've got all these things that happen over time. Well, they happen not because, Bernie Madoff was a little different. SBF, probably different. But, if you look at all these situations, there's probably a lot of good people. They're well-meaning, trying to do the right thing. And it ends up that, someone else missed something, and then the whole system implodes. That's how these crises start. That's how 2008 happened, is people were just taking risks that they didn't think were risks, and they just thought everything's going to be okay. And they weren't checking their assumptions. So we're going to talk a lot more about risk management on the show because it feels to me like this might not be a bank run, but there might be more hiccups after this. And I remember 2008 being very much like this, where there were a lot of hiccups throughout the year until October, when it was a big enough hiccup where the whole system fell apart. But I think it's a time to be prudent. It's a time to understand your risk. It's a time to be prepared. I'm not saying go live in a cave with your guns, your gold, and your MREs. You don't have to put on your tinfoil hat, Doug. I've got mine for you. So you don't need this. But I do want everybody here to be prepared. So Doug, let's take it home. Final thoughts, and where can people find more about you?
Your guns, your gold, your tinfoil hat might be fun though. For entertainment purposes only. Although, if anybody hasn't seen it, if anybody hasn't seen it, go out and pull up Weird Al Yankovic's parody of Lords Royals. He does one called Foil. It's actually one of his.
It's so good.
It's pretty funny. The other thing I was going to say is, again, people don't do the research, but it's not like this data wasn't out there. There's a gentleman, it had a tweet. His name, it goes by Citrini7 at Citrini7 on Twitter. He took a short in SIVP in October 21st, 2022. Now, again, shorts happen. I'm not saying call it, but there was a reason he took that short, is because he said, if you look at their marked holdings to their market book if you mark their holdings to market, their book value would be negative. That was October 2022. I don't know, Kirk, when the Forbes article came out, but again, and all these Wall Street analysts came out, but that data was out there. He found it, which tells you how little research a lot of these analysts are doing. It also, again, sometimes, as a reminder, a lot of these analysts will put out their recommendation based on what their back office is holding. Money, there is oftentimes a little bit of incentive and bias in the way they put out these recommendations. There's an old joke, Goldman Sachs says buy, that's the time to sell. Okay, so just remember, I'm not saying that's true. Don't hold me to it. It's a joke. All right, well, speaking of regulation, speaking of the government and their decisions that they make, I think it's a great segue for us to take a look at college. Okay, about 10, 15 years ago, guess what the government did? They decided to step in. Instead of backing student loans, they decided to become the primary lender of student loans. Well, guess what that created? It created an unchecked increase in the cost of college, because colleges could lend whatever they wanted, knowing that the federal government would be happy to back it up, and ultimately put rules in place that nobody could default on it for any reason whatsoever, and in many cases on the private side, including death. There's nothing else in our lending system as egregious as this, which has led to the trillions of dollars that we have in debt in the United States, billions and billions of dollars that we have in the student loan debt. Listen, it's a real thing. And it doesn't matter what financial situation you have. Everybody at all levels thinks the cost of college is too high. But the difference is that probably 95% of people aren't doing anything about it. They're not going about it the right way. They're not learning how to get the cost down and how to pay for college in a way that's going to protect their hard-earned money. If you, no matter what your financial situation is, don't want to overpay for college, you need to start looking at this now. It's never too early. It's never too late. But if you've got a child in high school, ideally a freshman, sophomore, junior, it is time for you to get on this and take it seriously. And we've got some ways to help you with a 9-step program, the simple way to get you through to finding the right college, the right fit academically, financially, and socially. And go to our website, ProCollegePlanners.com right now. Download our 2022-2023 financial checklist. Okay, this gets updated every single year. So we're going to be putting the new one out as soon as the new numbers come. Go get it right now. It's information you need to know to start this journey. ProCollegePlanners.com, free checklist. Get it now.
Awesome. Well, Doug, once again, I appreciate having you on the show. This was a fun conversation. I'm sure we're going to have much more to talk about this coming Friday. If you want to join us live on LinkedIn, you can ask your questions. We will answer them on the show.
That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.